Unlock the secrets of the global financial system in one simple video. We break down the 12 core concepts of modern finance, accounting, and market trading, starting with the most powerful investment tools in the stock market. From option strategies to ledger bookkeeping, this comprehensive guide simplifies complex ideas to help you master your wealth, secure your financial freedom, build generational wealth, and grow your net worth. A call option gives an investor the right, but not the obligation, to purchase a stock at a specified strike price within a set time frame. Traders utilize this financial instrument to speculate on rising prices. When the market value of the underlying asset rises significantly above the strike price, the call option becomes highly profitable. The holder can execute the trade or sell the contract for a substantial profit. However, if the stock price remains below the strike price at expiration, the option expires completely worthless. The investor loses the entire premium paid to purchase the option, demonstrating its high-risk nature. Managing these positions requires discipline and risk tolerance. A put option grants the holder the right to sell an asset at a predetermined strike price before the expiration date. This contract provides essential downside protection against falling prices in volatile markets. Investors purchase puts as insurance for their stock portfolios, ensuring they can exit positions at a locked price. Speculators also buy puts to generate profits directly from declining market trends and corporate crashes. If the asset price stays above the strike price until the contract expires, the put becomes worthless. The seller of the put retains the premium, while the buyer accepts a total loss of investment. This serves as a powerful hedging mechanism. In double entry bookkeeping, a debit is an accounting entry that increases asset or expense accounts or decreases liability and equity accounts. It is always recorded on the left side of a ledger sheet. When a company purchases new equipment using cash, it records a debit to the equipment asset account. This reflects an increase in owned physical resources, balancing the corresponding credit to the cash account. Understanding debits is fundamental for maintaining accurate financial records and producing reliable balance sheets. They ensure that every transaction maintains the core accounting equation where assets equal liabilities plus owner equity. This system prevents accounting fraud, error, and discrepancies. A credit is an accounting entry that increases liability, equity, or revenue accounts, or decreases asset and expense accounts. It is systematically positioned on the right side of the ledger balance sheet. When a business secures a bank loan, it records a credit to the cash account's counterpart, the liability account. This indicates a growing obligation to repay borrowed funds to the financial institution. Every credit entry must be balanced by an equivalent debit entry to keep books perfectly aligned. This double entry system prevents errors and ensures that accounting statements remain accurate and compliant with standards. It provides a clear audit trail for regulators and internal examiners. Assets are valuable economic resources owned by individuals or corporations that are expected to generate future cash flows. They include physical properties like buildings and equipment, as well as cash, accounts receivable, and investments. Current assets can be quickly converted into cash within one fiscal year, providing immediate liquidity. Fixed assets represent long-term investments like real estate that support business operations over many years of production. Managing assets efficiently is vital for corporate growth and maximizing shareholder value over time. Businesses must balance their asset portfolio to ensure both operational stability and long-term financial health in competitive markets. Protecting these resources is key. Liabilities represent the financial debts and obligations that a company owes to outside parties such as banks, suppliers, or employees. They are settled over time through the transfer of cash, assets, or services. Short-term liabilities must be paid within 1 year and include accounts payable and wages. Long-term liabilities represent extended commitments, such as mortgages and corporate bonds, that mature over several fiscal years. Excessive liabilities can lead to insolvency if a company cannot meet its payment deadlines. Financial analysts closely monitor debt ratios to assess a firm's long-term viability and risk of bankruptcy. Balancing debt with current income is necessary for long-term survival. Equity represents the net value of an asset or company, calculated by subtracting all liabilities from total assets. It represents the actual ownership interest held by shareholders or business owners. In corporate finance, equity is raised by selling shares of stock to public and private investors. Shareholders receive equity ownership, which grants them voting rights and potential dividends from corporate profits. Retained earnings also contribute to equity, representing profits that are reinvested back into the business. Growing equity indicates a healthy, expanding company that is successfully generating value for its owners over time. This metric serves as a key indicator of shareholder wealth and corporate strength. Bonds are fixed income securities issued by governments or corporations to raise capital for projects. Investors buy bonds, essentially lending money to the issuer in exchange for regular interest payments. The issuer promises to pay a set interest rate, known as the coupon, until the maturity date. Upon maturity, the issuer returns the original principal amount or face value to the bondholder. Bonds are generally considered safer investments than stocks, providing stable income and capital preservation. However, they are subject to interest rate risk, where rising rates cause existing bond values to decrease. They are a staple of conservative investment portfolios for retirement planning. Derivatives are financial contracts whose price is dependent on or derived from an underlying asset, group of assets, or benchmark. They include options, futures, forwards, and swaps traded globally. Market participants use derivatives for hedging against price fluctuations or speculating on future price movements. These complex instruments allow traders to gain leveraged exposure to commodities, currencies, and interest rates. Due to high leverage, derivatives carry significant risk and can lead to massive losses. Regulators closely monitor derivative markets to prevent systemic financial crises, as seen in past economic downturns. They require sophisticated knowledge to trade safely, manage volatility, avoid catastrophic defaults, and protect investment capital. Dividends are distributions of a portion of a corporation's earnings to its shareholders, approved by the board of directors. They are typically paid in cash or additional shares of stock. Established companies with stable profits often pay regular dividends to attract long-term investors. These payments provide shareholders with a steady income stream, regardless of current stock market price fluctuations. A high dividend yield can indicate a mature business with limited reinvestment opportunities. Companies that choose to retain earnings instead of paying dividends usually reinvest profits to fuel faster corporate growth. They represent a reward for loyal shareholders who support the company's long-term vision. Interest rates represent the cost of borrowing money or the reward for saving it, expressed as a percentage. Central banks adjust interest rates to manage economic growth and control inflation levels. Higher interest rates increase borrowing costs, discouraging consumer spending and business expansion. Conversely, lower interest rates make loans cheaper, stimulating economic activity but potentially leading to inflation in the long term. Investors monitor interest rates closely, as they directly impact bond yields and stock. Market valuations. Changing rates influence consumer behavior, mortgage pricing, and the overall stability of global financial markets. They dictate the flow of capital worldwide across all nations and economies. Mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. They are professionally managed by investment firms. Investors buy shares in the mutual fund, allowing them to easily diversify their holdings with relatively low capital. This diversification helps reduce risk compared to investing in individual stocks. Mutual funds charge annual management fees, known as expense ratios, which cover operational costs. They offer an accessible way for retail investors to participate in the broader financial markets. They are ideal for passive retirement planning strategies, long-term wealth accumulation, and individual financial independence. Which of these 12 financial concepts do you think is the most important to master for long-term wealth, financial independence, and compound growth? Let us know in the comments below, and don't forget to subscribe for more simplified financial breakdowns. Share this video with a friend who is starting their investment journey today, and we will see you in the next explanation video.